Hi, thank you so much for joining us on this afternoon for the Louisville chapter of KAPAAW's first event of 2020. You could have easily stayed in the house today, shopped online, you could even be catching up on sleep, but instead, you decided to come out and join us today for this event, and we appreciate you. I apologize that I'm not able to be there in person with you on this afternoon. I had a family emergency. However, I still trust that you will get something valuable from this presentation. But before I get into it, I would like for everyone to pull out their phones. And no, it's not church. I'm not going to ask you to put them all on silent, but that's only because I'm not there. Because if I was, I would ask you to turn off your phone. But I want you to pull out your phone. Everybody got them? Put in your password, do your fingerprint, facial recognition, whatever you got, get it on. And I want you to click on Facebook, okay? And when you get on Facebook, don't start scrolling, stay with me now. I want you to click on what's on your mind. And let's see, 4 from the top, there is the option to check in. I want you to click that check in button, and then it says add location. We're going to search for places. We're going to put in South Central Regional Library, okay? Once you do that, you will see a spot that says attending. You are going to put in vision. And when you put in vision, the event that you're at right now should pop up. It'll say Vision Passion Board 2020 Louisville. You'll select that. And once you do, it should have a status popped up, populated. Mine says Timalyn S. Bowens EA, attending Vision Passion Board 2020 Louisville at South Central Regional Library. Then there's still that spot that says what's on your mind. In that section there, if you're here with a friend, then I want you to put here with my girl, here with my girls. If you're here with a group of friends, or if you're just here by yourself, put here to try out something new, kicking it with KAPAAW. And then I would love if you would go ahead and post that. And the reason for that is KAPAAW is now officially in Louisville, but as I reached out to different women here in the city, a lot of them haven't even heard of the organization, don't know it exists, but they're looking for something like this. So by you putting that out there, that's helping us get the awareness out so that other ladies can find us for our future events, which of course I hope to see all of you in person at next month's event or For the Culture game night. So now that everybody has created their status, they've checked in, everybody knows all your business where you're at this Saturday afternoon, let's go ahead and get into this presentation. So before we get to the tax stuff, I will introduce myself. I am not just the lady that's not there today. My name is Timalyn Bowens, and I am also, there's a picture of me just in case you can't see my picture too well up here in the box. I am the Director of Member Services for the Louisville chapter of KAPAAW, which is one of the reasons that I wanted you to help me get that awareness out because we are looking for new members. I believe this is a wonderful organization and we have a lot to offer. So I would love for you ladies to join us. Not only that, I'm not originally from Louisville. I'm actually a transplant. In June, it will be 12 years that I've lived here now. I came to get a degree at Bellarmine University. I did graduate with a degree in accounting, and I have a minor in professional writing. I'm also the owner of Bowens Tax and Bookkeeping Solutions. So if you're active in the social media world, then you may have seen me in Buy Black Blue or different pages similar to that. I am also an EA, so if you find me on Facebook, you can look me up exactly the way my name is printed there, Timalyn Bowens EA, and a lot of people ask me about that. So I'm an enrolled agent. I'm licensed through the Internal Revenue Service to provide tax planning, consulting, advising, and resolution work, as well as preparation. I am also a QuickBooks Pro advisor. With that, I help businesses to track their income and expenses, as well as help them to scale, to grow further, and hit those goals, to not just become something that everybody recognizes on social media, but to actually be doing the work and making the money, help them go from 6 figures to 7 and on. But I have most definitely talked enough about me. I wish I was there in person to learn more about you. That is why if you check in and tag KAPAAW, I'll be able to see you and connect with you that way. But I know that if you're here today for this presentation, you are not here to learn about me. I know why you're here, and this is why. This meme makes me laugh every single time I see it on social media. When you start your new job and they ask you how much in taxes you want taken out. Now, we may have all laughed, but it's true. You're here because you want to learn how you can pay the least amount of taxes or none at all if at all legally possible, right? I can't see you guys, but I don't believe there's a single person in here that if I said who loves paying taxes, who wants to pay the most in taxes this year? Nobody is going to raise their hand to that, right? After the past presidential election, we've all heard too many stories to count claiming Trump didn't pay taxes. We've heard about companies like Amazon made money and didn't pay taxes. And we want to be like that too. Now, there's something I want to point out here though. Did you hear me say that those companies, Amazon, Donald Trump, his companies, did you hear me say that they didn't file taxes? That's something I want to note because there's a thing, unfortunately, that happens a lot in our communities is we see that other people are doing things when we get fed up and we're like, well, they don't pay their taxes, I'm not going to pay mine either. They yet filed their taxes. So if you are rebelling right now, you want to be like Trump, you don't want to pay taxes, so you're not filing, sis, I got news for you. The IRS is coming for you. The way that those people are able to get away with not paying taxes isn't by tax evasion and not filing. What they've done is they've either educated themselves or they've hired somebody that's educated in tax law to use the tax law to their advantage. And I am a tax nerd, so that's the kind of stuff that I like to study. But there are legal ways to reduce and cancel out your income to be like this. So make sure that you are still staying compliant and filing so you'll be eligible to take advantage of some of those ways. What we want to do is educate ourselves on how to make the tax law work for us or find those people that are educated to teach us, okay? Not trying to say, go out here, don't file your return, not trying to see anybody go to jail. Let's do it the right way, okay? There's so much of the Internal Revenue Code that covers different deductions and credits to help you to get to that point. Because I am limited on time today, my time with you is actually very limited because I am recording, so there's nobody to like raise their hand or do like this and make me stop. So I want to make sure that I stop on time and that I respect your time because I know that you're going to be creating beautiful passion boards today. So I'm going to try my best to give a general overview of what I feel will be relevant for us today here in the Commonwealth of Kentucky. So these are the three main topics I'm going to be covering. I'm going to be covering federal updates, federal 2019 tax updates, excuse me. I'm going to be covering Kentucky 2019 tax updates, and I'm going to cover some things that you need to do when you are in search of a professional to file your tax return. And again, because we're limited on time, this will not be a all dig in. It's going to be very surface, but it's going to also give you some direction so you know where to search to find more resources and answers. Now, I know that you see a chart here with income tax rates. I want you to just close your eyes. Don't look at that yet, because I've been told I look at the tax rates and it's overwhelming. Some people get their W-2s and they're overwhelmed. And what they do is they don't deal with it or educate themselves. So then when tax time comes, it's even more overwhelming. And what I want to do today is just make you aware of some things so it's not quite as overwhelming. And from today, you can kind of pivot how you do things to help you for next tax year. Because where we're at right now for the filing season we are in, everything you did last year is what's going to affect this tax season. But hopefully you'll be able to take what you learned today, look at what you did last year, and pivot so that you can have better results next year. So before I can jump into this year, I have to address last year. A lot of people were affected by the tax reform. Some people benefited from it, while others were hit in ways they weren't expecting at all. I remember before taxes were actually filed, people were asking me, like, is it good or is it bad? Honestly, it just really mattered on who you were. And no, I don't mean who you are in a race thing or money-wise. There were a lot of different factors because it wasn't just our tax rates that changed. The standard deduction also changed. Exemptions were eliminated. There were a lot of different moving parts, so it just depended on how those moving parts affected certain people. The majority of things that took place will be in effect until at least 2025. So I'll go over some of the important things today. And I say at least 2025 because that is what was passed officially via the law. However, we know how the tax reform was viewed as a huge political thing. So depending on how the presidential election goes, I hope that whoever gets in office next would not waste time on trying to flip this, since it will automatically expire in 2025. But everything that happens in politics is not always logical, right? So the first thing I want to point out is the standard deduction. Essentially, it doubled. And what that did was it reduced the amount of people that itemize deductions. So if you are a person that gets overwhelmed with taxes, or you are just now starting to file on your own, if I start throwing out these terms, this is usually where I would tell my audience, hey, I'm talking taxonese, like above your head, just raise your hand. So since I'm not there with you and you can't do that, I'm going to try to be very mindful to make sure that I am not doing that. So if I am describing things that you already know the definition of, I apologize, but I just want to make sure that in this presentation, I'm not leaving anybody behind. So what the standard deduction is, let's take your check stub, for example. So let's say you make $20 an hour, then you work 10 hours that week. That's $200, right? Any and everybody in this room that's ever had a job knows if you work a certain amount of hours, you multiply that times what you get paid, it's not what you get to take home. But that amount is called your gross income. And that is the number where your tax return starts. It all starts with your gross income, which if I was there with you in person, I probably would have heard somebody groan because it doesn't seem fair. Why would your income, your tax return start at the gross income when that's not the actual amount of money that you get to take home? Honestly, that's just the way the law's set up. I don't have a logical explanation for you. What the standard deduction does, it's supposed to take into account kind of like your very basic necessities for living. Prior to the tax reform, if you were single, the standard deduction, and I can't remember it exactly off the top of my head, was about $6,000. So, like I said, your very, very basic living necessities, which in America, who really can live off $6,000? But that's a completely different topic for another presentation. What the standard deduction does, you subtract that from your gross income to get your taxable amount of income. So for a lot of families, this is helpful, and I will use my own for example. My husband and I, we file married filing jointly, which you see that in the middle. So let's say, for example, that we made $90,000. Let's just keep this very simple for math purposes. We made $90,000. Without the standard deduction, we would be taxed at the 22% level. So what the standard deduction does, it allows us to take that $90,000, and prior to the tax reform, it would have taken us down to $78,000. So then we would have been able to be taxed in the 12% bracket. Awesome, right? Well, tax reform said, you know what? We care about the American people. What we're going to do, we're going to double that standard deduction. So now, my husband and I, married filing jointly, making the $90,000. Now we don't get to just subtract $12,000. Last year, the first year where the tax reform went into effect, we got to deduct $24,000. So what that does, it brings the amount of money that we're actually taxed on down. So for us, most people, that's a no-brainer, that's a benefit. But however, what that did, it helped some people that didn't itemize. Now, an itemized deduction, what the IRS allows you to do, you are allowed to optimize. So you have certain things that you can deduct, and if it adds up to be more than the standard deduction, you can take that. So prior to the tax reform, if you had people that owned homes, they could write off things such as their mortgage interest, their property tax. Another thing that was deductible on the federal return, or is deductible on the federal return, is your state taxes. So if you live here in the Commonwealth, you would deduct taxes that you paid to Kentucky, that you paid to Louisville Metro, that you paid when you renewed your car license, not your car license, your car tags on your car. There's a part on there that's for property tax, the property tax on your home. It was all good. People were doing that. Well, when the standard deduction doubled, it eliminated the amount of people that could itemize. Now, for me, it wasn't as good. When you itemize, that's an extra form you have to file. That's an extra form somebody would pay me to do. But for Americans in general filing tax returns, it was good for them. They don't have to keep track of as much stuff. And for most of them, they're getting a higher deduction. Now, stay with me. There's always a catch when the government's wanting to give you more money, right? Like, out of their goodness of their hearts, they're just going to double the standard deduction. So there was a downside to it. They got rid of the personal exemptions. But so many people were focused on, yay, the standard deduction doubled, they didn't really pay attention to the personal exemptions. Again, I catch myself speaking in taxonese. If you're not familiar with the personal exemption, maybe you're familiar, you've heard of people stealing, let's not call it stealing. Let's be friendly here today. Let's call it borrowing. Maybe you heard of people borrowing children. So My brother and sister-in-law have a son, so maybe they have a better tax situation than me, and I think I'm going to owe, or I can get a bigger refund than they can if I claim their child on my tax return. So what people were doing was allowing relatives to claim them, or friends where if they had multiple children, they would allow another friend to claim their child to help reduce their tax liability or to even get a bigger refund. So what the IRS said was, we're going to double the standard deduction, and then we're going to get rid of personal exemptions. Well, some people weren't exactly affected. Using myself as an example again, my home was not affected as much by that, and this is why. Prior to tax reform, personal exemptions were $4,050. There are only 3 people in my home. There's my husband, myself, and my daughter. So that's about $12,000, right? Well, our standard deduction went from $12,000 to $24,000. We take out the exemptions, I'm still about the same thing. When I had a standard deduction of $12,000, then those 3 exemptions were about another $12,000. I'm still shooting in the same ballpark. However, there were people that it hurt. There were people that it helped. So let's say that you were single and you had a standard deduction before of around $6,000, and then that exemption of 4, well, then that was $10,000 you were taking from your gross income before finding your taxable income. So for a single person, doubling that standard deduction took them to $12,000. So that was $2,000 more dollars that they got to deduct. So good for them. But here's the part where it hurts some people. Let's say that you have a family of 6, okay? So we have 2 parents and we have 4 children. So the 2 parents, their standard deduction, it went up from $12,000 to $24,000. Amazing, right? However, they just lost 6 exemptions. Now, do you remember how much I said those exemptions were worth? $4,050 times 6. So that's $24,000. So for that family, they were actually better off if we're only looking at standard deduction exemptions alone. They were actually better off the old way, because now the new way, that $24,000 is what they're deducting before their taxable income, whereas before they had the $12,000 plus the $24,000, which means they were reducing their income by $36,000. So you'll hear it both ways, like, oh, it was terrible, oh, it was great. And that's why, just because, as I mentioned earlier, there were a lot of different moving parts to it. There were some other things that were not affected. If you have gone to college in the past 15 years, you probably have student loans. One thing that remained is that you could get a deduction for student loan interest paid. Hallelujah. I'm still paying back some of those loans for Bellarmine myself, so that's one that we take advantage of. That is a deduction. If you are in college now and you are doing all your filing on your own and paying for it yourself, you may have noticed there's something called an American Opportunity Credit or a Lifetime Learning Credit. Those also are still in effect. Now, here I want to take the time to explain the difference between a tax credit and a tax deduction. So let's look here at trying to make up somebody. Let's say we have Mary, okay? And Mary is in the 12% bracket. After her standard deduction, her taxable income is right at that $19,401, okay? So Mary has the opportunity to take a $2,000 credit or deduction? I get this question all the time. Which one is better, credit or deduction? Or I get people tell me, oh, they're just the same, and they are not. So what a tax deduction does is it reduces your taxable income. Like I mentioned before, the standard deduction. All it does is take your gross income and then it subtracts from that. And then from there is where the tax percentage is applied. So let's say that Mary has a $2,000 tax credit. Right now her $2,000 tax deduction. Right now, her taxable income is at that $19,401. So if Mary has a tax deduction, that's going to take her down, to $17,401 that she's taxed on. So that means that Mary is only going to get taxed 10% on that now since she dropped down to a new tax bracket. Amazing, the world is happy, she's paying under $2,000 in taxes now. But check this out. A tax credit, which is usually what I try to go for with my clients if the option is there. A tax credit does not lower your taxable income. What a tax credit does is lowers the amount that you owe. Because a lot of people, I'll say, so what was your tax liability last year? Anyone that worked last year has a tax liability. Tax liability doesn't determine whether or not you have a tax refund. Tax liability is how much you would owe based on your taxable income, then applying the tax rate percentage. What happens when you get a refund is because you're working at W-2 job, we have a pay-as-you-go tax system. So let's say you work for the city. You don't have the option to wait and pay in April, right? You turn in that W-4, they do your withholding, and they're paying for you as you go. So really, if you don't have any children and you have a huge refund at the end of the year, that is because you had a lot of money unnecessarily withheld from your check throughout the year. Which, if you are not good at saving money and that is what you use to reward yourself, by all means, go ahead. But if you're like me and you hate loaning out money and it's not making money, then looking at your withholding is something I would definitely look at. Now, I do need to apologize to you. I was trying to explain what a tax credit was, and I just went off on a whole nother rant about doing your withholding, but I'll come back to that later. We still have Mary. Her taxable income right now is $19,401. So she's paying about 12% of that, and contrary to popular belief, I am not a human calculator. So and Mary's single, by the way, okay? So I'm going to get my calculator and I'm going to tell you all how it's figured. So what you see right now is the tax percentages. Excuse me, you see the tax percentages? It's not that directly. There is an actual formula that goes with it as well. So I'm going to take that 19,401 and multiply that times 12%. And I'm going to actually subtract $194. So her tax liability is $2,134. But remember, I said she has a $2,000 tax credit. The tax credit reduces your liability. So right now she has a $2,134 tax liability. We're going to apply that $2,000 credit, and guess what happens? It subtracts $2,000 from that. So now her liability is only $134.12. And guess what? Because we have a pay-as-you-go tax system and her employer has been paying in for her, chances are very likely she's paid way more than $134 in during the year. So because she had that tax credit, it ate up some of that liability, and she's going to get a refund of what she already paid in. This is usually the part where I would say, was that clear? Does anybody have any questions? Again, I apologize, I'm not there with you in person this afternoon. If you do have questions, I will give you a way later on to reach out to me and ask me those questions. So if you have questions, please go ahead and jot them down. So just a few minutes ago, when I went on my whole rant about withholding, your withholding is something that you want to check probably every year if your income fluctuates. So if you or a spouse have a new job, if you just got married this year, if you had a child, you definitely want to check your withholding. Me personally, I hate, and I know that's a strong word, but I absolutely hate giving anybody more money than I have to give them. I hate paying interest. I hate paying the IRS. So the reason that you would check your withholding is to make sure that you are not overpaying the IRS. But like I mentioned before, if you are bad at saving money and you use that to go on vacation, do whatever, more power to you. If you're like me and you don't want to give them any money, but you just want to make sure you don't owe, you also want to check your withholding. One place a lot of people got messed up with the tax reform is there were so many warnings. Like the IRS had so much stuff out that I was like, okay, people are going to check their withholding. But guess what? You all didn't check your withholding. So when you start a new job, or even now in February, because things have changed a little bit. So in February at your jobs, you should be getting the opportunity to change your W-4. You've probably seen emails about it already this year because I think the deadline for it is February. But you're actually able to change your W-4 at any time. Just make note of that. They can't tell you that you can't change your W-4. What your W-4 does, it tells them how much to withhold from your check. Please note, this is where people get messed up. They don't fill out their W-4 correctly because they don't read all the way through it, and somebody told them to just put 0. Now, even if you do read it, you will see that if you put 0, single, that will have the maximum amount of money withheld, which is cool. You don't want to owe the IRS, right? But people get tripped up because most people nowadays have a 2-person income household. It's really hard, unless you just have an amazing job, to raise a family, do anything for leisure and fun if only one person has an income. So what happens is you have 2 people who fill out 2 separate W-4s, and then at the end of the year, they don't know why they owe. If you owed last year, if you are working multiple jobs, if you have a child that's about to graduate and leave the house, please get your pen and paper now because you are going to want to take notes on this. When you fill out your W-4 and you only do the first page, it does not take into account your spouse's income, and that is the reason that you owe. I'll say it again. When you only fill out the first page of the W-4, it does not take into account your spouse's income, and that is why you owe. If you don't have a spouse and you work multiple jobs, if you only fill out the first page, even if you're putting 0, you can't figure out why you owe, that is why, because it's not taking into account the other person's income. While we still have the tax rates here, let's look at another example. Let's say we have 2 spouses and they both make $50,000 each, okay? Now, spouse 1, they go to work, they don't want to owe the IRS, and they put their withholding, they put MFJ, which is our middle tax bracket here, the married filing jointly, and they put 0 because they want the maximum amount withheld, right? Spouse 2, they don't want to owe the IRS either, so they do the exact same thing. So we're going to use the middle. They are going to put married filing jointly. They're going to put 0. This is what happens in the HR department when they turn those in. Married filing jointly. We said the standard deduction is $24,000, right? So when they do that and put 0, it is calculating that this household is only making $50,000 and they have a $24,000 standard deduction. I really wish that I was there with you all so I could hear the reaction to see if anybody caught on to what's happening. So let me say this again. They're turning in the W-4, each person to their own job, but because they've only filled out the first page, it's only taking into account that the household has $50,000 in it with a standard deduction of $24,000. So it's only withholding as if that family is going to make $26,000 to be taxed on. So if $26,000 is our taxable income, that W-4 is withholding for them to be in the 12% bracket at the very low end of it, right? But we know, they know, their house is not going to make $50,000. It's actually going to make $100,000 at least. God forbid they get any kind of bonus or pick up some extra side income. So what they really needed to have the withholding for is not the $50,000. It needs to take into account the whole $100,000, and that is why they owe, because excuse me. That's why they owe, because that's not being taken into consideration. One moment. So if you're single, you can see how that can affect you as well. Let's say you're single and you work jobs that only they're part-time. So maybe you work 2 jobs on the side where you make $5,000. And then you have 1 full-time job where you make $30,000. So if you're putting 0 on those W-2s for your $5,000 jobs, let's look at it. Let's go to the single taxable income. If you're only making $5,000 and you have 0, it's putting you in the 10% tax bracket, but it's also factoring in that standard deduction. They're not withholding anything for you at the federal level. So that's $10,000 that nothing is being withheld on, which is cool, because remember, you have that $12,000 standard deduction, but oh wait, you also have a job where you make $30,000, which is going to put you in the 12% tax bracket, and all of that is getting taxed because your standard deduction was used on the others. But your $30,000 job doesn't know that. So you're going to end up owing big time because everything is off and you've only filled out 1 page of the W-4. So here's something that people do not take advantage of. Yes, you can hire a tax professional such as myself. There are others out there that will figure out your W-4 for you. However, the IRS has provided you with a free tool to do this. So what I want you all to do, go ahead and pull out your phone again. And you are going to go ahead and go to this site, which I know by now you may have a pen and paper. If you're writing it down, you can write it down as well. But I want you to actually go to the site so you can see it, and then that way it'll stick, okay? So you're going to go to www.irs.gov. And once you get there, you are going to go to withholding calculator. And once you put that in, this tool is actually beautiful. You're going to want your tax return from last year. You're going to want your most recent check stub. If you have a spouse, you're going to also want their most recent check stub. If you have multiple jobs, you want your most recent check stub from all the jobs. And it will also, if you paid any student loan interest last year, or you have any other above the line deductions such as student loan interest, it will ask for that as well. And what the calculator does, it helps you know what to put on those W-4s so that you don't end up owing at the end of the year. Now, it's a free resource, but keep in mind, its job is to help you not owe. So it's not going to make you get a huge refund. It just makes sure that you don't owe. Unless you are being strategic with it and you put that you want them to withhold extra. Unless you do that, withholding calculator is not to get a bigger refund. It's just to make sure that you don't owe, that you get as close to zero as possible. It's an awesome tool. Like I said, if you get flustered with it, of course you can hire a tax professional to do that for you, but make sure that you are utilizing all the free resources that you have at hand. So let's get to Kentucky, and I am running out of time. So I'm going to try to get through here. So for Kentucky, when we had the tax reform last year on the federal level, states had the choice to do their own reform as well. Kentucky was a state that did choose to do reform. So in the past, we had been a state that had a progressive tax rate. Now, Kentucky decided that everybody was going to be on one tax rate. So we have a flat tax rate of 5%, and that's income tax, not sales tax, because our sales tax rate is still 6%. But on your income is a flat 5%, which isn't the end of the world. However, they also eliminated some very common itemized deductions. Like I told you before, on the federal level, they doubled that standard deduction. So there's stuff that people typically would have itemized that it's not that they can't now, it's just more of a benefit for them to go ahead and use the standard deduction. Well, Kentucky said, nope, we're going to put everybody on a flat rate, and we're going to tell you some things that you can't deduct. Some of these deductions were the local tax. So before in Kentucky, anything that you paid to St. Matthews, Louisville Metro, J-Town, like that, you could deduct it off your tax return. That's no longer an option. Another thing, the property tax. So if you owned a home, the property tax I mentioned on the car before, you could also deduct that. Now that's no longer an option. So for some people, they raised what the effective tax rate was, and then they eliminated what they could deduct. So there were a lot of people, I would say even close to half of my clients last year that actually owed Kentucky, because another thing that they did was when the tax reform passed, we were all pretty much ready for the federal. If we weren't ready, we had heard about it. But Kentucky passed theirs a little bit later. It kind of slid it in on us, so a lot of people weren't ready for that at all. For Kentucky, the standard deduction is $2,590. Now, you may look at that and say that's a lot lower than the federal level, and yes, it is. However, the federal tax return is the basis of the Kentucky return. So what I mean by that, you can't file a Kentucky return without having a federal return done, because there's something called the AGI, which is your adjusted gross income. As I mentioned earlier on the other slide, you have your gross incomes, what you start at. Then after you deduct things like your student loan interest, other credits and things of that nature, how you get to your AGI. So once you are at your AGI, that is the starting point for the Kentucky return. So that's why it's a little bit lower. Also, let's be honest, we're not doing too good with our budget, so we were not expecting tax breaks there anyway. There are some things that you can yet itemize. However, it's very difficult to do if you do not own a house. Some of the things were you could still deduct the home mortgage interest, and you can deduct charitable contributions. But if you only gave one bag to Goodwill and $10 to your church, you're going to be better off taking the standard deduction. So don't even keep that Goodwill receipt or that $10 for your church. The amount has to be above the $2,590 for it to even make any sense for you to itemize. And no, you cannot increase your charitable contributions by using the logic here in this meme. This is another one that really cracked me up. It says, my body is a temple, therefore I am a church and exempt from paying taxes. Yeah, that is not quite how it works. If you start using that logic, the IRS will be for you, and Kentucky will soon follow. One thing I wanted to point out here is the pension exclusion. If you have taken advantage of any employer's retirement benefits, such as a traditional 401k, traditional IRA, you will notice that they reduce it from your income on the federal part, but not on the state and local part. So since you've been paying taxes on that as you were earning that money and putting it away, what Kentucky allows you to do is when you pull it out, up to a certain amount, you can exclude it from your income and not be taxed on that. So that's something not everybody benefits from because not everybody's in a position to contribute to those. If you are, though, I would strongly suggest that you go ahead and start contributing to those. You may have to sacrifice some things, especially if your employer is doing a match program, because that essentially is going to be free money for you, especially if it's a Roth, because a Roth you'll pay tax on now. Let's face it, unfortunately, tax rates will rise later, and then when you pull it out, it would be tax-free. I wish that I was there with you all to hear and get feedback. Like I mentioned, please do write your questions down. I do have a few frequently asked questions I'm going to address at the end. However, if you write them down, I will give you a way to send those to me. I just haven't given you that way yet, just in case I go ahead and answer your question. I don't want you to send me a whole bunch of questions that I'm going to answer later on. So that's why I'm waiting to do it at the end. Now that you have those brief updates, I wanted to point out some things about choosing a tax preparer. One of the things you want to make sure that you do is check the qualifications. As I mentioned before, I'm an enrolled agent. A lot of people aren't as familiar with that designation. You can actually go and check my qualifications and prepare history on the IRS website to make sure that my credentials are still active, that I have not been, I had a complete brain fart, I'm sorry. To make sure that they haven't been stripped from me and I still have my rights to practice. The same with an attorney. You can check with the state, make sure they haven't been disbarred, or a CPA. You can also check with the State Board of Accountancy to make sure that they have not. I'll be quite frank with you, we have a lot of people popping up to be tax preparers. The only real requirement to be able to prepare taxes for pay is to have a P10. A P10 is our identification number that we use to sign them. You can have a high school degree and go get one of those. That's why, depending on the complexity of your return, you will want to check the credentials. But everyone should have at least a P10. If they do not have a P10, they're not authorized by the IRS to be completing returns for pay. Ask about their service fee. One thing that the IRS has made illegal and something you want to watch for, if anybody is telling you that your fee is going to fluctuate based on how much your refund is, that is a no-no for us. It's illegal. You need to run and probably report them. The IRS also says to stay away from stay away from preparers that promise to give you a larger refund. That one gets sticky because, of course, we know a lot of people advertise that way, unfortunately. But the reason that they say to do that is because then that tax preparer is, what's the word I want to use? They're motivated to get you that bigger refund, so then they may not do everything like by the book. So they're compromised. There it is, because they're too invested. So, for example, if you were to come to me, I would tell you based on the forms that I need to fill out how much it would be. Whether you owe, get a refund, that ain't got nothing to do with me. My fee is going to stay the same. That doesn't matter. Ask to e-file with all of the identity theft that we have going on and scammers. The IRS uses e-file because it's most efficient. One way that you can find out if your preparer is not all the way on the up and up, if they really prefer to paper file. Paper file takes forever to process, for one, but two, if you are going to do that, just don't do it. Anybody that lets you paper file, don't do it. Of course, there are some exceptions, like if there was a mistake on your return, then you have to do an amendment. That does have to be paper filed, but anything else, like for current year, you want to make sure that you are getting e-filed. If they have a problem with that, then that's probably somebody you want to go check on their credentials. Another thing that you can do, there's something called a P10 directory, PTIN directory, just for kicks and giggles. If there's a tax preparer you know, and you know what state they're in, or a zip code, you can go type their name in and you'll see if their P10 is actually active. If it is not, it's another one you want to run. Go find somebody else. You'll want to make sure that your tax preparer is available, because after you file, maybe you get a notice, maybe you have a question. You want to make sure that you have somebody that's available all year round. You also want to make sure that you have somebody that asks you to provide records and receipts, because if they are just taking your word for it, they could be doing all kinds of foolery on your tax return. And the main person that's going to be liable for that tax return is you. They'll come for you, then the preparer. So you always want to make sure that you have somebody that is using true source documents and not making up stuff on your tax reform. Not your tax reform, on your tax form. Stay away from the foolery. Next, never sign a blank return for the same reason. There have been cases where the IRS has fined, and some people have gotten jail time because they would have a client sign a blank return and then they would do whatever they wanted with it. So maybe they would put a fake business on it, or they would create fake deductions, and then there's a way to send your refund to separate accounts. So what they would do is they would create this fake business with extra deductions, or they would create different types of deductions and credits, and then the amount that they told the client they were getting, they would send to the client's account, and then they would pocket the other in an account for them. So you always want to make sure that you always review the return before you sign it, and never ever sign a blank return, because as I mentioned earlier, you are going to be liable for that. Finally, you want to ensure that the preparer always signs. If somebody has work that they've completed, it's their profession, and they don't sign it, that should be a sign of sketchiness anyway. I can tell you that I am proud of the work that I do, and I will gladly sign it and send it off to the IRS after you pay me. Last but not least, nothing else when you're looking for a preparer. After you see this face, you should look no further, right? No, but on a serious note, everything that I just mentioned, if you have been the victim of a ghost preparer where they weren't available, they took your money and did not file, you can reach out to me. I will send you a form because the IRS actually does want you to report that. So that will stop being such a common thing. But you do have rights as a taxpayer to get that fixed with the IRS. So here are some common questions that I get before the tax season starts. When will the IRS begin accepting tax returns? This year it will be Monday, January 27th. And again, I apologize, I'm not actually there with you right now to answer more questions. If you yet have questions, what I'd like for you to do is pull your phone back out. We're going to keep getting on Facebook, aren't we? Go to Facebook, and I want you to type in Bowens, so like my last name, Bowens, Tax and Bookkeeping Solutions, and hit message. Now, this is important, especially since it's tax season, because I get a lot of messages. Type in there, hi, I was at the KAPAAW event today. Because then when that comes up, I'll go ahead and put priority on those and check them faster. And put your question in. Chances are that you aren't the only person with that same question. So if I have enough people asking the same question, I'll create a video. But if there's not that much interest in one, I'll probably just shoot you a message back, or I'll set up a time to do a phone call, because that is a lot easier to communicate versus sending messages back and forth. But also, while you're on my page, you go ahead and hit that like button. And if you like this presentation, please give me some stars and post what you liked about the tax overview. It will be greatly appreciated. If you have any suggestions for how it could be better, or questions for some other presentations that I do, because usually I don't do a tax update or overview, it's more concentrated. So if you have a question about any other presentations I do, go ahead and send that to me as a message as well. Like I said, any feedback, anything that I could do better, suggestions that you may have for other presentations, please let me know. So when can I expect my refund? Refunds are released within 21 days from IRS acceptance. They can take a little bit longer sometimes, and sometimes it's only like 5 days. However, what I will let you know is for families that are claiming the earned income credit or the additional child credit, by IRS mandated law, those refunds will not be released until mid-February. Sometimes the end of February. It depends on how smoothly things open up this year. The reason for that, there is a lot of fraud that takes place with people claiming children that aren't theirs. And while the IRS is doing their best to crack down on it, it's still not perfect. So they hold those refunds. And even if your complete refund isn't earned income credit or additional child credit, they do hold the whole refund, not just that portion. Question I get all the time, can I file with my last check stub? Not legally. So question, yes, you can. Should you? No. Preparers that do that, less than ethical. We are not supposed to, even for refund advances. Banks tell us not to, but there are preparers out there that do it. So with you not legally being able to do it, no, don't come to me and ask me to do it, because I absolutely won't. Because sometimes numbers do change, and that will, if you're trying to rush and do it just so you get your refund faster, if that goes in the system and the system picks up something different on your W-2, that will hold up your tax refund. All right, and I have like 12 seconds, and I am sorry, ladies, I'm almost done. We're gonna do this last part. For members only, my company is offering a 10% discount off any tax service for all active Louisville chapter members. So you may see this and be like, dang it, I want that discount. You don't have to be a member right at this moment. I will wait for you. You go ahead and sign up right now. No, but seriously, you can become a member by going to KAPAAW.org. Once you get to the website, you can scroll down and select Join Now. In order to receive the discount, I just need to see your confirmation that you have joined. That is all for me. Again, thank you so much for coming. Enjoy your time together creating vision boards. I look forward to seeing pictures of all the beautiful, I'm sorry, I said vision boards, passion boards. Enjoy your time creating the beautiful passion boards. I look forward to seeing all the pictures of them today. Again, as I said, I am working with outreach and recruiting members. If you have any questions, you're on the fence about joining, please feel free to link up with me on social media. You can find me on Facebook as Timalyn S. Bowens EA. I have the same thing as my handle on Instagram. Also, right here in the room with you, you have Miss Miles. Charnice, go ahead and wave. You have Miss Deborah Payton. Go ahead and wave, Miss Payton. And you have Miss Washington. They would also be more than happy to answer any questions that you have. And again, I'm sorry I had to miss today, but I most definitely look forward to meeting and seeing you all at our game night. You all have an awesome time today.